Hi, everybody. Thanks for joining in today. This is Shaun Carney with Bolt Financial Group discussing some of the myths that are out there about investing because too often have people come into the office and start, talking about how they heard some advice from their brother or from someone at the golf course or, the person in the cubicle next to them at work. And they're like, what do you think about that strategy? In fact, I got off a phone call earlier today. Someone was asking me what I thought about Apple. And I said, you really got to attend our webinar because we're really going to kind of dive into what are some of the myths out there about investing and how can you better protect yourself from really the bullies of Wall Street so that you don't fall into the same traps that are out there. And so it's a really powerful lesson about not only is it the everyday common person that fails to understand some of the hidden secrets of investing, but it's also a lot of times the big firms because they're out there trying to sell something because they have to differentiate themselves from their competitors. But all they're really doing is selling an old return, which has no indication and no predictability about what's going to happen in the future. So really powerful lesson that I'm glad everybody's tuning into. If you have questions along the way, please raise your hand and we'll go ahead and answer them because we want this to be as interactive as possible. So without further ado, let's talk about the myths and truths of investing. All right, so the purpose of this is we're going to dispel some of those investing myths. We're going to tell you the academic story of investing. So we don't want to just tell you why everything's bad, but we also want to tell you, how are academics investing? How are some of the endowments and how are they teaching it in all the institutions across the country so that we can give you the way that you can improve yourself moving forward. And then we'll give you the opportunity to achieve true peace of mind with investing because ultimately that's what we all want. We want to not have to listen to what's happening on Fox News or MSNBC, and we want to know that what we're doing is going to help us be successful in the long term. And there's so much noise out there today because you can turn on the TV at any point in time and be just inundated with someone talking about why the markets are going up. And then 5 minutes later, another person on there talking about why the markets are going down. And it creates a lot of stress in our lives. And if you just follow the academics and you ignore all of that nonsense, you can achieve that peace of mind that we all seek with investing. And so we'll give you some of the tools to help yourself moving forward. All right, so what is a myth? A myth is a story made up to explain a phenomenon beyond the science of today. And so what are some of those common phenomena that we are unable to explain with investing? The first is that stock selection exists and that you can be superior at investing by picking the right stocks. It doesn't necessarily have to be the right stocks. It could be the right sector, whether that be oil and gas or real estate or international or domestic, small, large, whatever it may be. Are you able to pick a certain stock and improve your odds? The next myth is that you can look at how well stocks have done in the past, and that will be a good indication of how well it's done in the future. And this happens every day with clients that come into our office because in their 401ks, I ask them, how are you getting advice or how are you picking your investments? And almost 100% of the time they say, I just kind of look at which ones have done well in the past and then I move my money to that fund. And we'll show you why that's so destructive. And then market timing, right? And I get this question all the time. Hey, what do you think the markets are doing? And especially this last week where the markets were down, 3-4%. And everyone started panicking. What do you think the market's doing? Are we on our way in a downturn? Do you think it could rebound? And it's so much stress because if you're thinking that all the time, you have to try and time the market. You have to try and get in and out at the right time. And you have to know information that's really not knowable. We all know you can't predict the future, but if you want a market time, you have to try and gamble and predict the future. The fourth myth is that the costs of investing are readily available and that we know them all. And this happens all the time with a lot of people. And I always talk about there's really two kinds of people in this world. People that don't know something and they know they don't know it, right? And those are people that are, rational people, right? I know I don't know everything about investing And I know that, but I can try and go to get educated and, look for help, and I can improve myself. But then there's the people that think they know, but they don't actually know. And these are the people that really suffer from the cost of investing. They'll say, I know what I'm doing. I know that I've got to go find the lowest cost funds. I've got to buy those. I've got to, try and mitigate transaction costs, and, all that stuff is readily available to me. And then I'll start to ask them about bid-ask spread and some of the other costs that are hidden in there. And they're like, what are you talking about? And they don't realize how all those things eat into their return. So we'll kind of disclose some of those costs of investing so that you can have confidence that you kind of know what's going on with all the different costs and transactions that happen when you're buying and selling stocks. So for the first myth, stock selection is choosing stocks based on the belief that they will do well in the future. Okay. And the myth is that investment advisors can consistently and predictably add value through picking these individual stocks or funds or sectors, whatever it may be. And to kind of dispel some of that, right, we've got this survivorship bias up here. This is a list of all of the mutual funds that have been started and created since 1923. And you can kind of see, initially, there weren't a whole lot of mutual funds. As we started to get into the 1970s, we really started to see a whole lot of new mutual funds being born. And we also started to see in the third column a number of dead funds. And essentially what that is a company creates mutual funds, and they know how people invest. They know people look at the track record and buy a fund. So they'll start mutual funds, and if they do well, then they'll keep them alive. If the mutual fund does not do well, they'll start to close them, right? So those are the dead funds, because they don't want to keep them open. They just want to start a new fund. So they continually start new funds every year and then just close out the bad ones. And this really started taking effect in the 1970s when the ERISA Act started, and we started to see companies move away from defined benefit plans or pension plans and go more towards defined contribution plans or 401k plans. And the amount of mutual funds, new mutual funds, started being just ramped up exponentially to where today there are 32,945 mutual funds. And up to this point, over 61,000 mutual funds have been started, while 28,000 mutual funds have been killed. So you can see companies keep starting new funds and then just closing off the dead funds. And hopefully your money's not in them, but they don't know which fund's going to do better. So they try and put everyone's money in every fund, and then they kind of slowly move money out of the bad funds into the good funds. And by good funds, I mean the fund that did well in the past, which has no, correlation on whether or not it will do well in the future. So what happens if you were in the 200 worst mutual funds? Well, they lost about 82%. All right, from 1923 to 2016. So if you happen to be in one of those bad mutual funds, which no one knows which one they are, because if the companies knew what was a bad mutual fund, they wouldn't have started it in the first place, and they wouldn't put anyone's money in it, right? Advisors wouldn't do that. But the fact of the matter is they do exist, and clients do have their money in them, and advisors do put people's money in those funds. So hopefully you're not one of the mutual funds that lost 81%. All right, so if you look at the average of all mutual funds from 1972 to 2016, if you had put in $10,000 and continually made investments, you'd have $3.5 million, over 50 years later, if you're in the average mutual fund. If you're in the S&P 500, and we hear Warren Buffett talk about this all the time, if you just buy the S&P, you'll be okay. You reduce cost. You get a lot of volatility, but if you had done that, you'd have about $7 million in 2016. If you had just bought the entire market, diversified, you had a little bit of small cap in there, some large cap, international, you had some domestic funds in there, you'd be up to $7.4 million. So the average mutual fund crushed investors by the tune of about $3.8 million, right? Because you aren't in the best mutual funds necessarily. Hopefully, But there's advisors and there's companies out there that have so many to choose from, they don't really know. And so by not following a disciplined strategy and listening to some fund manager or some advisor that tells you that they know which mutual fund is going to do the best, it can actually cost you almost twice the amount of return. And there's study after study after study that validates this claim. So let's take a look at what happens if we just look at some different types of mutual fund based on risk tolerance. All right, and so we go back to 1972 and invest at $100,000 in 1972. The average of all mutual funds about 50 years later, not just equity funds, but now we're throwing in fixed income, some bonds, would have got about $1.7 million 50 years later. Whereas if you took on an aggressive portfolio, you had a lot of tilt towards small value, some international in there, you could be up to $19 million. So the cost is almost $18 million from the average all mutual funds all the way up to a super aggressive mutual fund. So what we find is people don't really know what their risk tolerance is. They don't know if they should be an aggressive, a moderate, a conservative portfolio, and they're just blindly taking advice from someone. When that happens, it can compound the amount of error that's in there because no one's ever gone through and find out what your comfort is with risk, and no one's diversified your portfolio with the academics so you can achieve a return. Instead, they try and sell you some fund out there that some large company is pushing on them to sell, and therefore it crushes you. And you don't really know any better because that's the advisor, that's who you should be going to, that's who you think is the expert, when really there's so much data out there that just supports diversifying, passively managing your funds, and allowing the returns to come to you. All right, so myth 2, track record investing. So what is track record investing? It's using the performance history to determine the best investments for the future. So the myth is that finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. And again, I told you how this happens all the time in people, especially in people's 401k. So let's take a look at some of the track record. Let's look at the data that support this claim. From 1997 to 2016, the top 30 U.S. equity funds averaged a return of about 17.7, right? Where all U.S. equity funds only got about 8.07%. So they more than doubled. The top 30 equity funds more than doubled the average fund, right? Which is pretty impressive. In fact, the S&P in that time only got about 8.4, so doubled the S&P. So what we would see at this time would be everyone would be running those top 30 mutual funds, right? Everyone would say, man, those funds have done really well. Let me move my money to those funds. It happens all the time in people's 401k. So what happened from the next 20 years? Well, from 2007 to 2016, those same top 30 got a 5.3% return, while the market got about a 7% return. So they underperformed the market. So as all the dollars flowed over there to those funds, they underperformed their benchmark and what they were trying to beat. So let's take a look at another sample data set, right? Because people usually look at the 1, the 3, the 5, the 10-year return. So from 2007 to 2011, a 5-year period, the top 30 equity funds got a 5% return, while the S&P got about a negative 0.25%. Again, all U.S. equity funds got about a negative 0.12. So the top 30 drastically outperformed the benchmark. What happened the next 5 years? Well, from 2012 to 2016, the top 30 U.S. equity funds got about a 4.35% return, while the S&P got a 14.66. So underperformed what they had beat in the past by nearly 10%, right? So a drastic underperformance from their previous showing. Yet everyone's money had flowed over to them. All the advisors, all of the TV was touting the top 30 U.S. equity funds, saying these managers are superior, these funds are going to be better. And then 5 years later, they do nothing compared to what the benchmark does. And everyone's money just keeps bouncing around back and forth, creating transaction costs, creating all this anxiety about, am I in the right fund? Now I've got the answer. And then you look at what happens next 5 years and you say, why did I listen to that person this time? And then you change fund manager, you change funds, and it's just a perpetual cycle where people go up and down, chasing the return. So the truth is, a manager's ability to pick stocks in the past has little to no correlation with his or her ability to do so in the future. And that means consistently in the future. In fact, about 80% of fund managers are not able to outperform their benchmark, right? And when I say has little to no correlation, right, that's a compliance way of saying they cannot do it, right? Statistically speaking, if they do it, they're gambling, right? We just can't say with certainty they are, even though data and study after study suggest that that is the case. All right, so our third myth is market timing. Market timing is any attempt to alter or change the mix of assets based on a prediction or forecast about the future, right? So trying to change where you're at in the market based upon how you think the market will do in the future. The myth is that money managers are able to utilize market timing to effectively predict up and downs of the market. You see this all the time with people who are trading options, using leverage, buying real estate when the market's up or down, trying to get in and out of their house, whatever it may be. We see so much of this market timing. And it's disguised when people ask me, what do you think the markets are going to do? How do you think the market's going to do? And every time my answer is consistent. Over the long term, the markets are always positive. It's always green. So if you have a long-term approach, buy the market, diversify your portfolio, go in a portfolio that aligns with your risk tolerance and stay disciplined. That's not you. Don't try and time the market. It's probably not the place for you. And how do I get this kind of philosophy? Well, Dalbar Research Institute does a study every year. It takes a look at how the S&P 500 does compared to the average investor. And they update the study almost every single year. 1987 to 2016, the S&P got a 10.16% return. The Dalbar said the average investor in an all-equity fund got a 3.98% return. Underperformed the market by over 6%, right? And it's for a lot of different reasons. It's for some of the myths we've already talked about, trying to time the market, trying to get in and out based upon how they think things will do in the past, by putting other money in mutual funds that did well in the past, and then continually chasing returns. So why doesn't market timing work? All right. In this slide, growth of $10,000 investment. If you stayed invested from March 1997 through 2017 and realize that includes the 2002 downturn for the tech crash, the 2008 market crash with the housing. If you stayed invested in that time period, a growth of $10,000 would be almost $50,000. If you missed just the 10 best days in the market, right? So you took your money out for whatever reason, and the next day happened to be one of the 10 best days in the market, you lost almost half of the return by being out of the market for those 10 days. If you had missed the best 30 days over those 20 years, just 30 days, the best days of those 20 years, you would have not grown at all. So trying to get in and out is not going to be beneficial to you, because if you miss the best days, you're going to be drastically punished. And if someone tells you the same is true if you miss the worst down days, well, then if they know when those down days are coming, please let me know. Because if they knew, they wouldn't tell you. They'd be buying the whole market and selling it short. But no one really knows. So the best thing you can do for yourself is to just stay invested, stay disciplined, and keep plugging. All right. So beware of market timing, because it can be disguised as tactical asset allocation, right? And so we hear a lot about this in terms of market sectors. Oh, I think oil and gas is going to do well because, OPEC just had a ruling, or the financial markets are going to do really well, whatever it may be. And so they don't want to call it market timing. They'll call it something like tactical asset allocation. Well, they'll shift or have a tilt towards a certain sector during a certain time, or they're watching the yield curve. They've got all sorts of different ways of disguising what market timing really is. But market timing is not buying a portfolio that aligns with your risk tolerance and staying disciplined. It's trying to make moves between asset classes, between stocks, based upon some prediction of the future. And we all know no one can predict the future, yet we try to do it all the time in the stock market. And it ultimately destroys our wealth. Charles D. Ellis is the founder of Greenwich Associates, a leading consulting firm. And his statement on kind of track record investing and market timing is supported by academics. The evidence on investment managers' success with market timing is impressive. and overwhelmingly negative. And study after study after study supports his claim. All right, so the fourth myth, the costs of investing. Right, so what are the costs of investing? The fees incurred by investors to buy, sell, and own stocks or mutual funds. The myths are what you don't see can't hurt you, right? My advisor tells me what I'm paying him, and that's all that I'm paying. And what I don't see is not really going to hurt me. Well, we're going to talk about a couple different things. The bid-ask spread and mutual fund expenses. And these are costs that aren't really laid out for you anywhere. It's not open. You've really got to kind of go and dig to do your research. So what is the bid-ask spread? Let's say I wanted to sell 50 shares of XYZ stock, right? I might call my broker and say, I'd like to sell 50 shares XYZ stock. And that broker would say, you can sell those for $49.50. If I immediately said, you know what, broker, I don't want to do that. I don't want to sell them. I actually want to buy them. The broker would say, okay, you can buy them for $50 a share. You say, well, wait a minute. I could sell them for $49.50. If I want to buy them, I want to buy them for $49.50. Well, the broker would say, actually, we can't do that because there's something called a bid-ask spread. The bid-ask spread is what the market maker is taking. And think of the market maker as the person in the movies that is running around, you know, the stock exchange floor with tickets, screaming at somebody, saying they want to do something. They're the person that when you place a trade is actually going out and finding a buyer for you. A lot of this happens electronically, but they're entitled to essentially a commission of the price. And that commission is dictated by how easy it is to buy and sell that particular investment. So if you're talking about the S&P 500, which trades millions of times a day between hundreds of thousands of people, that'll be pretty low cost. If you want to go out and find some small cap stock or you want to buy some international stock, that's going to be a little bit harder to find a buyer. So there's going to be a higher bid-ask spread on that. And all of those costs are hidden to you, but they certainly add up as you continually make trades in your portfolio. And it's not only you making these trades, it's also within your mutual fund. Every time the fund manager is having turnover and buying and selling stocks within that mutual fund, there's also bid-ask spread charges for you. And so that's something that people don't necessarily understand or grasp or see. And so kind of some of the disparity between buying a large US cap or a micro cap, right? The bid-ask spread might be 4 basis points all the way up to 32.5 basis points. So it could be almost 8 times larger depending on the type of investment that you're buying and selling. And so if you buy a lot of international stocks or small cap stocks, and there's a lot of turnover in your portfolio within the mutual fund, whatever it may be, you're going to have a lot of charges that you don't necessarily see. So the other thing we're talking about is no-load mutual funds. And where no-load mutual funds come from was really Vanguard, right, and Fidelity. When they started their mutual funds, they essentially said, all these people out there are paying commissions, whether it be on the front end or the back end of their mutual funds. If we don't charge any of those commissions, right, no load, then we can really capture a market. And so a no-load mutual fund does not have any commissions up front or on the back end. And when I was in the commercial world in this business, working for a large firm, there are a lot of people that are selling Class A, Class B, Class C shares that have these charges on the front and back end. And it's really sad because no one should ever put their money in a fund that charges them a fee on the front or the back end if there's no load mutual funds out there. And so I see people come in, really sophisticated, wealthy people come to my office, and I look at their statement, and I see Class A shares, Class C shares. And I say, why did you buy the Class A share? Why wouldn't you buy a no-load mutual fund? And they're like, I'm not sure what that is. I said, well, you thought you invested $1,000, but you actually only invested $950, and then they charge you a fee ongoing, when you could have just invested the full $1,000 by not being a Class A share and buying a no-load mutual fund. So I ask you, would you rather invest $1,000 of your money or $950 of your money and give $50 to the advisor, the broker, right? So there's really no reason to not be in no-load mutual funds anymore. So far we've talked about stock selection, track record investing, market timing, and the cost of investing. So If all those things exist, what's the proper way to invest if the data overwhelmingly support that none of those traditional investment philosophies work? Well, the right approach is the academic approach. It's what we learn at the Air Force Academy. It's what they continually teach in graduate schools. It's what they teach in the Series 7, 66, 65, advanced education, the College for Financial Planning, whatever it may be. They talk about following the disciplined approach that is out there on Google, right? It's readily available to everybody, but fund managers and people don't use it because it's not sexy. It doesn't differentiate themselves from anybody. But overwhelmingly, the academics use it. The best and brightest investors in the world, like Warren Buffett, use it. It's just using discipline. And so we'll talk about what that academic approach is. All right. So it starts with the free market portfolio theory. And what the free market portfolio theory is an investment approach based on 50 years of sound academic investment research and accepted financial theories. When I say accepted financial theories, I'm talking Nobel laureate research, right? And so this isn't like, I've got some new thing out there, I think we're going to try it. These are PhDs that were blessed by PhDs across the globe with tons of experience in economics and finance that have said these theories are proven to be successful if you follow them. Yet people aren't following them, right? It's almost hard to hear, but it's true. And so it's a disciplined approach that seeks to capture market returns while managing volatility based upon an investor's risk tolerance. So there's three components of it. One is that free markets work. You must believe that the free markets will dictate the price of a stock better than someone else predicting the future. The second component is the modern portfolio theory, which is one of those Nobel laureate research. Component 3 is the three-factor model. Again, another Nobel laureate research topic that was proven by PhDs across the globe. So where does this come from? Whose ideas are these? It starts with people like Harry Markowitz, a Nobel laureate from the University of Chicago, Burton Miller from the University of Chicago, another Nobel laureate, Rex Singfield, University of Chicago, and Roger Ibbotson, another a Yale University professor, Eugene Fama, another Nobel laureate, and continues to teach at the Booth School of Economics at the University of Chicago, and Kenneth French from Dartmouth College, another Nobel laureate. Right, so these are Nobel laureates, PhDs across the globe that continue to teach at institutions that have proven through evidence that these theories work. So in a free market, at any point in time, the actual price of a security, or any good for that matter, will be a good estimate of its intrinsic value, right? And so think about a gallon of milk. So much milk is sold that eventually the price of milk is going to be determined by how much people are buying or selling it, or how much demand it has, right? So that's going to determine the price of it. What's not going to be determined the price of it is someone's prediction about whether or not they think the gallon of milk is going to taste good. Right? We're going to look at how much the milk is selling, and that will be the price. Well, the price of a security is the same thing. The price of a stock is the same thing. Right? There's only 32 million trades placed a day, and billions of dollars are being moved around the markets every day. If one person thinks they know more than the 32 million trades that are happening that day, why wouldn't everyone be doing it? How can someone think that they know more than the 32 million people that are placing those trades? All right, so free markets fail, right? So the markets fail to price goods and services efficiently. If you believe that, right? You don't believe in free markets. You believe it's possible for individuals to identify in advance which prices are inaccurate. Underpriced or overvalued markets can be forecasted or predicted. Managers seek to increase returns and avoid losses by taking advantage of stock market mispricing. So people with this view use traditional investment approaches, right? And if you really think about it, what they're saying is people believe that they can predict the future, right? And that's what, like, if I were to ask you, do you believe that someone can tell you what's going to happen tomorrow? You'd say, no, that's ridiculous. But if I told you, do you believe in a stock picker and a market timer that believes that they know what's going to happen in the future in the markets? People would say, well, I think that's probably possible. So inherently, we know predicting the future is not possible, yet people will try and do it in the stock market. Another belief is the free markets work. And how that opinion kind of shows itself is that free markets are the best determinant of market prices based on supply and demand. All available information is factored into the current price. Only new and unknowable information can affect the price change. The randomness of the market makes it impossible for any individual or entity to consistently, I say consistently, right? Because you can win the lottery once, doesn't mean you can make the correct picks of the number, every time moving forward. Consistently predict the market movements and capture additional returns unrelated to risk. Right? We're not looking for someone to be able to do it one time. They must be able to do it time and time again. So people with this view utilize the free market investment strategy. All right, so your beliefs dictate your action. If you believe that free markets work, then you focus on capturing market returns. You eliminate all those traditional investment strategies that we talked about at the beginning, all the myths. Utilize the asset class or structured funds, which take advantage of buying the entire market. You diversify prudently by having a little bit of domestic, international, small, large stocks and bonds. You truly diversify, not just think you're diversified. You identify your risk tolerance, and then you work with someone that helps you and shares that belief with you so that you stay on track. If you believe free markets fail, then you focus on active management, trying to get in and out of the market at the right time, using track records to make your investments, trying to predict the future, and you pursue those traditional investment strategies. You stay connected to multiple sources of financial information. Like, think about that. You got to listen to Fox News, MSNBC, the Wall Street Journal, Forbes. You got to read it all because you got to find that one nugget of information that nobody else knows so that you can get the price right. And then you got to get the price right every time moving forward so you don't lose that game. If you believe that, then you need to work with a financial professional who shares that market belief and does that work for you. All right. The second part of the component is the modern portfolio theory, which says diversification works. These are Nobel Prize winners from 1990. Harry Markowitz, economics professor at the University of Chicago, studied the portfolio design and risk reduction, which were later developed in the modern portfolio theory. Essentially, what Harry Markowitz found, right, in his research was risk and reward are not linearly related, meaning you don't increase your return 1 unit for every 1 unit of risk you take. You can actually bend the curve. You can actually increase your return by not taking on as much risk. Now, it's only to a certain point, right? There's no such thing as unicorns. There's no such thing that has no risk and a lot of return because you have so much diversification that gets rid of it. But you can actually bend that curve. And if we look at the kind of the standard S&P 500, okay, listen to someone like Warren Buffett, and it's sound investment philosophy if you just want to be simple, right? But the S&P 500 has a standard deviation from 1973 to 2016 of about 17, right? And if you really look at about every 10 to 15 year chunk, it's right around there. Right? It has about a return of about 10%. So about a standard deviation of about 17 and a return of 10. And people all the time will say, why don't I just buy the S&P, buy the S&P? And I said, well, if you're okay with that amount of risk, which shows itself in the markets by how drastically it goes up and down throughout the day, throughout the market, throughout the year, then a 10% return with a 17 standard deviation might work for you. But what Harry Markowitz research says is you can actually get the same return, that same 10% return, and almost cut your risk in half, almost cut the volatility in half so you don't have as big of ups and downs in the market. And the way you do that is by having lots of different asset classes, owning many, many different stocks of all shapes and forms. Oftentimes I'll see people come to my office, I look at their portfolio, and they have a lot of different mutual funds, a lot of different stocks, but they're all in one sector, typically domestic large cap stocks, which is essentially the S&P 500, right? And so I say you're essentially getting the S&P 500 return with the same amount of risk. Would you rather get the same return and lower your risk, or keep the same risk and get a higher return? Because we can do that for you by diversifying your portfolio. So it creates less anxiety for you. You get the same return, less risk, or if you're comfortable watching it go up and down, why wouldn't you want a higher return? And the reason we're able to do that, right, is because the determinants of how your portfolio does is not market timing. It's not picking the right stocks. The research shows it's actually how you have your assets allocated. And by that, we mean small, large, domestic, international, stocks, bonds, right? How much of your portfolio is diversified? Makes up almost 92% of your return. Just getting those simple factors right is going to make up the majority of your return, right? And the asset class correlation is very important. So if you're in all large cap stocks, all your assets going to be directly correlated, which means when one goes up, the other one's going to go up. When one goes down, the other one's going to go down. And by doing that, it creates a lot of volatility in your portfolio. Another strategy, right, by Harry Markowitz is have assets that are uncorrelated, right? You want to find different asset classes. When one goes up, one goes down. When one goes down, the other one goes up, right? So you want to have a good blend. And you do that by owning the entire market, by owning large, small, domestic, international, value, growth, stocks, bonds, right? The right blend to your risk tolerance so that you get the same return, if not more, with a lower risk tolerance. All right, so how does this work? In a very simplified example here, we'll look at January 1970 to December 2016. All right, we'll just look at kind of how diversifying your portfolio in a very simplified manner here, not saying go out and do this, will actually change your return. So from that time period, 1970 to 2016, the S&P 500 got about 10% return, standard deviation of about 6.4, right? So 16.4 on the risk scale, 10% return. Same time period, if we did 75% in the S&P and 25% in the international, you get about the same return, 10.25, and lower your risk to 16.1, right? So not big changes here, but this is a very simplified example. So we add in one other asset class, we get about the same return and lower our risk a little bit more. Let's do a little bit more diversification. Add 70% S&P 500, 20% international, 10% international small cap. Our return goes up to 10.8, so we increased our return 0.5%, and we lowered our risk to 16. So we lowered our risk by 0.5%, and we increased our return. That's the power of diversification. Again, a very simplified version. Truly, we'd have a lot more in there, but just a simplified version says, as you add different asset classes, you can actually increase your return and lower your risk. And this is what the academics say. Again, no market timing, no stock picking, just following academics to get a higher return and lower your risk. The other part is the three-factor model, which kind of expounds upon the modern portfolio theory. What they found, Jean Fama, Kenneth French found in their Nobel Prize-winning research was that there's three premiums in the market. The first factor is that stocks are better than bonds. The second factor is that small companies outperform large companies. And the third factor is that value companies outperform growth companies. And so here's the data to support their claim. Equities are riskier than fixed income, right? Equities think stocks, fixed income think bonds. So from 1926 to 2016, annualized data, the S&P got a 10% return, the standard deviation of about 19, while cash, T-bills, fixed income, got a 3.3% return, 3% standard deviation, which makes sense, right? Much lower risk, much lower return. That's what we think, right? This one's very easy for people to conceptualize. I get that stocks are riskier than bonds. And what that's really telling you is that if you're looking for return, you should have more of your portfolio in equities because you're going to be a higher return. Makes sense. Factor two, the size factor. Small companies are riskier than large companies, but they historically provide higher returns. Again, 1926 to 2016, the S&P got a 10% return at the 19% standard deviation. U.S. small cap got 11.5, with standard deviation of 30, right? So much more risk, but much more return as well, right? So not saying go put all your money in U.S. small cap stocks, but if you're looking for diversification and ways to increase your return, that's one way to do it, right? Again, evidence-based approach to investing. Then there's the value factor. 1927 to 2016, the S&P 10% return, 19 on the standard deviation. Value company got 12% return with a 26% standard deviation. Again, more return, more risk, right? All of it makes sense. So how do you use these, the academic approach to improve your portfolio? Free markets work, believe in it, quit trying to time the market. Modern portfolio theory, diversify across the globe, three-factor model, have a tilt in your portfolio to take advantage of the 3 premiums that have been proven by PhDs across the globe to exist and increase your return. When you do that, you get the free market portfolio theory. So how do you build a better portfolio using these academic approaches, right? Again, we're looking at the Dalbar Research Institute study. Average investor gets a 4% return while the S&P gets a 10%. Why are the returns so low? Because the average holding period for most people is only about 3.5 years, right? They don't have the discipline to stay invested. They're going to get excited about the story that their buddy told them at the golf course, or what the person in the cubicle next to us said, or what their Uncle Jimmy told them at the Christmas party, whatever it may be. People are not going to hold on and not have the discipline to stay invested. The same can be true with the diet, right? I need to lose about 30 pounds, but I don't have the discipline to consistently eat healthy, right? I'm going to change my diet, right? It's not every 3.5 years, it's about every 3.5 days, but that's the value of discipline, right? Trying to get a better result. Track record investing, chasing the market, right? People are they see how someone did in the past. They look at that fund's performance, they move all their money there, and it crushes their return. They actively stock pick. They hear how, Apple or XYZ stock, whatever it may be, is going to be the next pick. So they move their money there. It ends up that some other kid decided to start some new software company out of his garage, right? Do you think Microsoft knew that Apple was going to exist in the 80s, right? They had no idea. The same can be true for Facebook. How do we know that there's not someone that just dropped out of Harvard yesterday and is creating the next social media platform that's going to dominate Facebook, right? So people that actively stock pick are really hurting their chances. And then people trying to time the market, right? Everyone's scared. The market's been doing really well. I think the market's going to go down. In fact, I taught a seminar last week, and everyone's like, it's got to be going down soon. And I just asked them, why do you say that, right? So no one really knows why, right? They're like, well, it's been going well for so long. My biggest fear is that those people, they think it's going to go down, so they pull all their money out. The market continues to run because we have no idea what's going to happen, and they destroy their wealth. They destroy their retirement savings. All right, so how do we create a diversified portfolio and follow some of the basic passively investment procedures to be able to do this? If we just bought the S&P 500, right, call that portfolio 1, 10% return, 17% standard deviation, right? Let's add in a little bit of fixed income. 5-year government bonds, 1-year fixed income corporate securities, looking at 9% return, 10% standard deviation. Cut our risk almost in half, only lost about 10% in our return. Let's add a little bit more. So we'll add international small. We're getting 9.6% return, only 11 on the standard deviation. So we're getting more return, less risk. Let's add some U.S. small cap stocks, some U.S. small cap value stocks, some large cap value stocks. We get a higher return than the S&P 500 and a lower standard deviation, lower risk. This is how we invest people's money. Passively, building a diversified portfolio that takes advantage of the academics to get them the same return as the market, if not better, and lower their risk. So how do you create a free market portfolio theory? You follow the free markets, right? We have a free market U.S. equity position, a free market international equity, and a free market fixed income. We believe free markets work. That's how we invest. Our portfolios are allocated across the globe. We have over 14,000 positions across 45 countries. Our portfolios are truly diversified to get the most return possible so that we can help people invest their money academically to get the long-term returns that they're looking for. If you need help with this, we'd love to help you at Bolt Financial Group. Does anybody have any questions out there? All right, so we got one question in about fees. Yeah, so when you're looking at portfolios, trying to diversify and try and create the lowest fees possible, things that you're looking for are what really makes up a portfolio's return isn't just what you see, right? So there's things like turnover inside of a portfolio, how much that portfolio is churning. And what that really is if you bought the S&P 500 January 1st, would that portfolio still have the same 500 stocks on December 31st? Anytime those portfolios are changing, the mutual funds or stocks inside of there are moving around, that's turnover. All of those, every time the fund manager is buying and selling stocks, it's causing a transaction fee. When you're looking at transaction fees, right? Is your portfolio set up to have no transaction fees? Or is there the $7 trade from E-Trade or $4 trade from Schwab or TD Ameritrade, whatever it may be? How many times are you moving it out of your portfolio? Those are transaction costs that hurts your return. And then you look at the internal expense ratio, right? The internal expense ratio is that fee that comes in the prospectus that you receive every year. And that prospectus is about 374 pages. And on page 276 in 6-point font, it tells you what that internal expense ratio is, right? We always say that you should be looking for internal expense ratios lower than 0.5. With the market these days, there's no reason for anyone to be in a Class A, Class B, Class C share. You should look for no load mutual funds that have ongoing expenses lower than 0.5. If you're in something higher than that, there is a better fund out there, or a fund that does the exact same thing that charges you less money. If you do that, you're just putting more money in your pocket. There's no reason to be in a high cost mutual fund. So the goal is to lower the transaction cost, lower the amount of turnover, lower that, because that lowers that bid-ask spread cost, and then try and find a fund that performs or buys the things that you're looking for at the lowest cost possible. And that's what we help do with our clients. All right, so someone asked, how do they get started? That's exciting. So the best way to do it is just kind of reach out to us. You can give us a call. What we'll do is we take a look at your portfolio, right? So we want to find out what's happening right now in your portfolio. The best thing we'll do, we don't sell anybody, right? We're going to take a look at what you're doing. If you are truly diversified, if you have low-cost mutual funds in there, your portfolio is doing the things that you want it to do, we'll take a look at that and we'll say, just being completely transparent. Here's the internal expense ratio that you didn't know you're paying. Here's how much turnover is in your portfolio. Here's how diversified you are. And here's what you're paying for it. If all that makes sense for you and you feel good about it, then keep doing what you're doing, right? We're not gonna tell you that we can do something better. If they're following the academics, then that's great. If they do have all your money in large U.S. cap stocks, though, and they're charging you, loads, Class A, Class B, Class C shares, if you have internal expense ratios that are really high, we'll show those things to you. And at that point, you'll have a decision to make, right? Do you want to continue going to the advisor or doing it on your own and continually not getting diversified and paying their higher charges? Or do you want help building a portfolio that will, achieve your long-term objectives following the academics? So it's really taking a look at what you're currently doing by looking at your statements. We'll run what we call an X-ray. We'll take a look at your portfolio, tell you all those hidden fees and diversification factors that are in your portfolio. And then if it makes sense for us to work together, we can talk about it. But ultimately, we want to make sure that you're doing everything you can to achieve your long-term goals to help your family. All right, so that's it for the questions. If you guys have anything, please reach out to us at Bolt Financial Group. We'd love to help you. We truly feel like we follow the academics as best as possible. We really have been helping a lot of people that are being scammed by Wall Street, by people trying to churn their portfolio or sell them just whatever the latest and greatest mutual fund is, even though all the academics say to do just the opposite. So we'd love to help you here at Bolt Financial Group. If you have any questions to us, please reach out to us. Enjoy the rest of your day.